Chapter 11, Insurance. In this lesson, we're going to look at what it takes to apply for insurance, some different terms when it comes to insurance forms, having to pay premiums, and we're going to look at 2 out of the 4 main types of insurance for a household. Okay, so a proposal form is a form that you just fill out. So when you're looking to buy insurance, now this can be online forms as well, not just physical, okay? Or you can talk to somebody over the phone. I'm sure if you're getting car insurance, they'll do it on the computer system for you, okay? But we keep it just as a paper form. This is what it'll look like. So any form, you put in your details, your name, address, where you live, if you're getting a car insurance, details on the car. Okay, but the key thing with forms are to tell the truth, and it's called, the principle is utmost good faith. So if you don't tell the truth, the insurance company doesn't have to pay you compensation, and they will find out, especially when you go to make a claim. Okay, so the best interest to tell the truth. So the next step then is to get your premium. So it'll be calculated based on the risk you pose to the insurance company. So if you're a young driver, for instance, or if you haven't got enough experience, penalty points, then you're going to be a higher risk, and a higher premium will have to be paid then. So the insurance company agrees to provide insurance. Okay, so once the application form is filled out, they'll let them know how much the fee will be. So how much they'll have to pay if they're paying outright, or monthly if they want to pay in installments. So the fee is called a premium. Okay, so you either pay full or in installments, so maybe once a month over the year. So applying for insurance, then you fill out your form, and then you get the documents. So this will be sent probably in the post, or a lot now is done electronically through emails, secured emails with passwords. Okay, so you get your policy. Your policy just details everything that you're entitled to maybe breakdown assistance, maybe if you have the type of insurance, third party fire and theft, or even things like windscreen cover, okay, or step back no claims bonus. All that means is if you don't claim, if you do claim, you can still keep some of your no claims bonus, because that gives you a reduction in your rate for your premium. Okay, for the next time. You get a certificate of insurance, and you put that cert disc into your windscreen, into the holder there for the guards to see. Okay, so another type of insurance would be household insurance. The 4 insurances that we have here are home insurance, life assurance, car insurance, and personal insurance. We'll look at the first 2 in this lesson. So these are for households. Businesses would have similar insurances, and businesses would actually have a lot more. So we'll look at that later on. So the different types for households. Number 1 is home insurance. We're going to look at that now, and then life assurance. So home insurance, if you have a home, obviously you would insure it because it's very important. It's a valuable asset. So if there was a fire, theft, accidental damage, so there could be flood damage, maybe a burst pipe, accidental happening, okay, or it could be through frost or snow, and then pipes burst as well. So while not required by law, if you do get a mortgage, the bank will insist you get home insurance, because remember, the house is still theirs technically, and they want to make sure that the house is protected. Okay, so you can get what's called building insurance. So that covers damage to the house itself. All right, so maybe the roof might leak, or could be tiles fall off. For instance, the walls might crack, or the foundations. We call that subsidence, where the house starts to sink. All right, unfortunately, which would be awful. Contents insurance. So not only would you insure the building itself, it's good to insure the contents of it, especially if they're valuable items. Now, if you don't have valuable items, obviously that will reduce your insurance, but definitely have to insure the house itself for mortgage purposes. Okay, so maybe you might insure your furniture, valuable items, electronics, TVs, anything valuable. Or you could get all risk insurance, covers loss or damage to the person's belongings, even when they are outside the home. Okay, so maybe they have jewellery, maybe a wedding ring or engagement ring, and they'd be worried if they went on holidays they would lose it. So it'd be part of their house insurance. Okay, another one then would be life assurance. Note, it's assurance, not insurance, because you're assured, unfortunately, to die. Okay, so that's why they call it assurance. So you can get three types. Life assurance then could be broken up into whole life. We'll talk about that now in a minute, or endowment or term life. So these are policies also. You pay a sum of money every month. Okay, so you can get life assurance on yourself in the event of a death occurring. So to pay for or to leave money to your family, I suppose, to keep the household, paying mortgages, paying for everyday expenses, but also then maybe paying for funeral expenses as well. It's not required by law, but a lot of people take it out again to make sure that they can continue to pay bills, especially if they're the main income earner. So the types are term assurance. Think about it, it's for a certain term or time period. Okay, so maybe you do it for 10 or 20 years, and the insurance premium would be quite low because it's a shorter term. I suppose the likelihood of you dying within, and depending on your age, within 10 years would be low, and that's why the insurance premium would be cheaper. Okay, so you pay, what happens is a lump sum would be paid out if the person dies within that period. Okay, so the only difference between that and whole life is really, it's more if you died younger for whatever reason, and is to make sure that, again, your loved ones are looked after. Whole life is for your whole life, as it says, right? So it's a higher insurance that you have to pay for because you are guaranteed, or your family is guaranteed to get at some stage. Okay. So that's what it means there. The premium is going to be bigger. It's definitely going to have to be paid out. Whereas maybe the term life wouldn't have to be, because you probably won't die within 10 years. Endowment insurance pays a lump sum. Lump sum just means, a lump of money, maybe 50,000 or whatever. Again, that would be agreed on when you're taking out the premium. So when they reach a certain age, endowment policies can be cashed in at an earlier date. So it's similar to like a savings, really. Okay, and we call that the surrender value. So maybe you want to get it at a certain age, or maybe earlier, and you surrender it. So I'm sure there's some kind of penalty there for that. The longer the policy, though, continues, the more money you'll get. So as I said, it's very similar to savings, really. Okay, and we look at car insurance then the next day. So take down the chapter summary notes and do questions 1 to 3 in the book.